Hello, my name is Jonny Fry. I'm CEO of a company called TeamBlockchain based in the UK. And today, what I'm going to do is look at how, where, and why blockchain technology and digital assets are being used and the likely impact they're going to have on society and investors and businesses. So what I'd like to do is give a quick introduction to myself and my sort of career, look at some of the areas of concern that are out there, and in particular looking then at reasons why I believe that the new technology of blockchain and how it's actually going to impact on society, how you can actually embrace as opposed to be frightened about the volatility that we're seeing in crypto assets, and why risk-adjusted returns actually are very important for investors. Then a quick glimpse into sort of what we believe the future will hold for investors, and finally how to get a little bit more information. So to get into it, as I say, my name is Jonny Fry. I'm CEO of a company called TeamBlockchain, and my longer term sort of career has been involved in financial services in asset management. And I was CEO and actually established a business managing private client portfolios, pension funds and trust funds, and then went on and floated that business on the London Stock Exchange. I now find myself in a position of being a non-executive chairman of a fund administration business, managing the administration and compliance of mutual funds, as well as advisory position on a number of other businesses involved in blockchain and also outside of blockchain. So I've got a broad business experience. TeamBlockchain has actually been running monthly meetups since February 2017, and these are really masterclasses showing people how, where, and why blockchain and digital assets are being used and implemented. It's a series of case studies from startups all the way through to companies like IBM. And then we also have created something called Digital Bytes, and that's been going now over 2 years. And it's a weekly analysis looking at the developments in the blockchain and digital asset sectors. And if anyone would like copies of that, then they can just email me, and details of how to contact me will be available later. Alternatively, you can always contact Unicom for my details. Okay, so let's get the bad news out of the way first. These are areas of concern, and all of this has been brought into sharp relief, I believe, as a result of COVID-19. And one of the big concerns is the huge amount of sort of debt and the fact that government departments aren't really talking to each other. So in the UK, we have a crazy situation where on one hand, we're giving 2 billion sterling in terms of tax credits, yet one of our biggest supermarkets, Tesco's, actually is paid out to its shareholders a £600 million dividend because their profitability has been really good, and we have other supermarkets doubling and tripling the amount of bonuses they're paying to their staff. So on one hand, the government giving it, and yet the money the taxpayers are giving away is actually being paid out, and it's probably not really what the government's actually intended. We're also seeing, interestingly, the law is going to be changed in the UK and Germany around insolvency. So this means that directors can no longer or will no longer be held accountable in the event they carry on trading when they know their business has actually gone bust. And I think what we're going to see, again, right across Europe and America, as the gifts, the payments, the furloughing, as we call it in the UK, being paid to people not to work, as that stops, then I think what we're going to do is see companies actually making many people redundant, and that's going to cause a spike in unemployment and a potential detrimental impact on the economy. Small to medium-sized businesses actually account for in excess of 50% of the number of people employed in many companies in many countries, and these companies are really struggling to get cash. In the UK, we have a situation whereby it's very difficult, as it is across Europe, to actually get hold of cash because the banks, to many extents, have actually stopped lending money. And in America, it's easier to get large companies capital, but according to JP Morgan, it's very difficult for these smaller companies. And on top of that, we've got a decline in equity ownership. More and more people are actually investing in funds and becoming remote from companies, and we're seeing less and less companies coming to the public market. So in 2019, it was a 3-year low globally in terms of the number of IPOs, and across Europe there was a 40% decline in the number of IPOs actually being created. And a lot of this is because of regulation and costs. And then we have the situation of regulation. It's becoming increasingly very expensive and complex. TERs are total expense ratios. So your mutual fund may say it has a 1% annual management fee, But by the time you add in sort of marketing and administration and compliance and audit, you could find the total cost of running your fund could be as much as 3%. And a lot of this complexity is stifling innovation. And whilst in the UK, we've seen something called a regulatory sandbox, where the regulator is trying to encourage innovation, and that's now been copied in many countries across the world, it's still very, very difficult, and regulation is quite a barrier to entry. We also see many prices being overpriced. If you take, for example, Amazon, it's trading on a 65.6% price earnings ratio. Compare that to arguably the most successful investor in the world, Warren Buffett. His company, Berkshire Hathaway, is trading on a 17.5 price earnings ratio. The concern also is the potential decline of the US dollar, which it's been the world reserve currency for 94 years, but given the huge amounts of debt, there is again a big concern as to what the actually the short to medium term future. And as the US dollar hands on its mantle of being the world reserve currency, we're likely to see some quite significant challenges, particularly in some of the developing markets who have been very reliant and priced a lot of their economies against the US dollar. Okay, so I've talked about debt, and I call this the children's sort of story tale of the emperor has no clothes, where everyone knows debt is a problem, but they're not really prepared to do anything about it. And if you look at the amount of personal, corporate, and government debt in America, it actually equates to around about sort of 40 trillion. But if you look at the amount of equity that US banks have, actually they only have 1.8 trillion. So roughly a 5% default in debt in the States could actually wipe out the banks. And those debt figures are actually worse in places like China. India has a huge debt problem, and right across Europe, debt is a massive issue. And indeed, before we had any of the government handouts that we've seen this year, at the beginning of 2020, debt in the world was in excess of 250 trillion. Now, what is surprising, even some of these massive companies that we're familiar with, the Googles, the Amazons, the Facebooks, they're all actually got huge debt. Because if you look at the S&P 500, so these are the 500 biggest market capitalization companies in America, only 15 are net cash positive. And the two companies that are fairly well known are T. Rowe Price, which is like a broker dealer, and obviously Facebook. All the other companies, including Amazon, including Microsoft, including Apple, they're all sitting on net debt when you take into account the amount of cash they have compared to the amount of borrowings they've got. And probably even a greater concern is the European Central Bank now owns in excess of 10% of all the European corporate debt. So this is a real problem and a real challenge we're going to have to try and to come with. And as you can see on the right hand side of this slide, you can see the amount of sort of long-term debt, which is going to present a real headwind for economic development. However, what we're seeing though with blockchain technology are new types of assets. And what we've seen with crypto, so the Bitcoins, the Ethereums, things like that, there are over 5,500 of these, which were launched in sort of 2017, 18, and into 19. They're now giving way to digital securities. So these are digital investments backed by either a bond or a commodity or an equity or intellectual property or players' rights, if in the case of basketball or football and things like that. And what we're seeing is the ability to effectively create new asset classes. So if you take, for example, in America, you have the Empire State Building, and it's not possible to actually currently just buy a part of the Empire State Building in terms of the rental income from its different tenants. But there's no reason why you couldn't actually create a token which would give you exposure just to the bottom layer of the Empire State Building, say for shops, or just the middle layer, which may account for offices, or in some buildings they have offices, they have shops, they have retail, they have hotels, they have apartments. So with a digital asset, it would be possible to give you exposure, not to the capital, but just the income flows from that. And then we've also got the idea of being able to monetize sports stars contracts. So again, in America, we've seen an individual called Dinwiddie, and he basically signed up a national basketball contract for 3 years worth $32 million. And he then issued a debt instrument, like a bond, for 10 million. And that 10 million that he's managed to actually issue into a digitized security is backed by a $30 million contract from the National Basketball Association. Now, you're probably wondering, what on earth am I talking about by having a picture of pirates and a Jolly Roger down the bottom of this slide? Well, what this is looking at is how pirates were financed back in the sort of 15th and 16th century. And essentially what happened is the kings and queens of Europe went to pirates, or pirates came into the royal courts and said, look, can you lend us some money? You know, we're a French pirate, and we want to go and buy a ship, get men, guns and arms, and then we want to go and steal the gold off of the Spanish ships as they're coming over from South America, or we want to take the spices off of the Dutch ships or the British ships. And the Brits were doing the same, and the Spanish were doing the same, and the Dutch were doing the same. So basically, pirates were being financed by the shake of a hand. And in many instances, it was actually the crown, either kings and the queens, and then all their, as we would call them, high net worths, but it was all the aristocracy and the landowners. They basically gave money to pirates on the understanding, when you come back, we're going to share in the booty. So we're going to divvy up the gold. You'll take some, pirate, and then we will take the rest. Now, there was no company involved, and there was no debt instrument. There was no bond that was created. It was simply, we will share in the endeavors of your exploits. So this flies completely in the face of the Howey test in America. But it's interesting to see that we've now got work being done, and the first example of this is actually come out of France, where now French authorities are saying, yes, if you've got an existing business, we're happy for you to have a French approved initial coin offering. And if you can create a vehicle that is like a loyalty point and that has some utility value, then we're happy to say, yes, that meets with our rules and regulations, and then you can use this as a funding mechanism. And they're really relying on a 500-year-old precedent that effectively helped finance pirates. So I suppose in some ways nothing's new. And then we have something called an equibond, which is being developed here in the UK, whereby investors, instead of actually having a share in the profits or the dividends of a company, they're actually going to be paid a share of the income. So if we take a very simple example, and let's say the company is turning over $5 million, and people invest, let's say, $500,000 in order for them to be able to help, you know, maybe take on another contract or maybe employ some more staff. The investors actually would then say, okay, we will have 10% of the revenue over 5 million until our $500,000 has been repaid. So in that situation, the investors put in $500,000. As the turnover goes in excess of 5 million, then the company has an obligation to pay 10% of that money back to the investor. So once the company has turned over 10 million, then the investor has the money completely back. So now they're out of that investment in terms of risk because they've had the money back. And then from a longer term perspective, they then get maybe a 2% EBITDA, earnings before interest, depreciation and tax, as an ongoing residual income. And what you're doing there, you're aligning the investors want to invest in good, strong, fast-growing companies, and the shareholders and management who are trying to grow their business. So both of them are getting a benefit from the growth of turnover, as opposed to relying on paying a dividend out of profit, because we all know profits can be changed and manipulated. They can decide to invest in new equipment or take on new staff. So they can reduce the profitability for the sake of getting extra turnover, but that means there's no dividends potentially. So one of the reasons why we're very optimistic about the situation, despite the huge amounts of debt and political uncertainty, and despite the the horrendous death toll that's been created recently by COVID-19, we believe that blockchain technology is able to help businesses and society in many different ways. And the word that continually comes up, so every week we write this thing called digital bytes, looking at how, where and why companies and governments are using digital assets, crypto assets, and how they're using the technology. And the one word that keeps coming up is trust, because using blockchain technology, you're able to see much greater transparency and information about what's happening and going on. So an example of this is recently, because of COVID-19, people have realized that 97% of the antibiotics that are used in Europe and America actually come from China. Many people didn't realize that. In France, basic over-the-counter drugs like sort of paracetamols for headaches, something like 65% of the active pharmaceutical ingredients come from China. And this isn't to say people should be anti-China, but from a risk point of view, does it make business sense? Is it sensible for society and healthcare systems to rely on one country? And therefore, once you've got the information, you can then make a decision, we're not going to do anything, or no, we would like to start sourcing some of our materials from other parts of the world in order that we're not exposed just to one particular region. The other thing which is very interesting, as we see more and more countries weaning themselves off of fossil fuels, we're going to see more and more microgeneration of electricity. So this might be a solar panels on your homes or a wind turbine. And at the moment, you don't get very much money for selling your surplus power back to the national grid. But with peer-to-peer energy, what we're able to do is someone who receives a lot of sun, maybe on the south-facing slopes in the northern hemisphere, is able to sell their surplus electricity to an office or to their neighbor and get a much better price. And this means you get a better return on your money for investing into these small renewable energy systems like solar and wind. And therefore, it means more people will be encouraged to do that and speed up the reduction of fossil fuels and increase the amount of renewable energy generation that's actually going on. And then finally, we have something which is an economic theory, been around for many years, about 20 odd years, called nudge economics. And nudge economics essentially is encouraging you to change your behavior. So a good example of that is that in cars, we have seat belts. So there's a seat belt in the car, and indeed some cars actually prompt the seat belt to come in over your shoulder to put it on. So you're being nudged to actually change your behavior and put a seat belt on. Again, in many economies, we don't have one refuge bin, one rubbish bin. We have two or three, one for paper, one for plastic, one for glass, maybe one for general household rubbish. And this is encouraging you to change your behavior, and it makes recycling much easier. And SC Johnson, the big company that makes things like boot polish and air fresheners and things like that, they've actually teamed up with a company called Plastic Bank. And what they're doing is actually paying non-working children and ladies in places like Egypt and Indonesia, and they're paying them in a token, in a cryptocurrency, whereby what they do is if you pick up plastic and you take it to the recycling bank, they effectively then put a token on a mobile phone, so you can't spend that money on on alcohol or anything like that. But what you can then do is then go to the shop and spend your tokens on books and clothes and food and medical drugs and the like. And that's encouraged over 8,000 tons of plastic to be recycled in some of these countries by using this token, which is running on a blockchain, to actually change your behavior and improve the environment. Now, a lot of people are worried about investing in cryptocurrencies because they're concerned about the volatility. And one of the really powerful investing stories that I believe in, having sort of been in the money markets for coming up for sort of 40 years, is saving money on a regular basis. So here we have an example of just assuming you put £15 a week, so that's 50p a day, into different assets over the last 3 years. So you would have actually invested $2,355, and had you put that into the US stock market, your money would actually gone up by 2.3%. It would now be worth 2,400. But as you can see, had you invested it into Bitcoin, it would have risen by 52%, turning a 2,300 into 3,500. And by regular savings, when the price of an asset, in this case Bitcoin, is low, you buy more of them. When the price goes high, you buy less of them. Now, no one knows when the right time to buy any asset is. But by regular savings, not only does it help you accumulate money, but it also helps you to embrace volatility, because it means that regardless of whether the price is high or low, you continue to invest the same amount of money and able to build up a sum of capital over a period of time. So that's the power of compounding and making volatile assets work well for you. Now, this is something all about risk-adjusted returns, and many investors, what they tend to focus on is just how much has my money made, but they don't look at how was the money made. How much up and down did I suffer? What was the volatility? What was the zig and the zag? And so, in a small standard deviation, so for example, if you took 1,000 Indian men in a room, then they're all going to be somewhere between, say, 5 foot tall and let's call it at an extreme 6-7 foot tall. So there's actually only a 2 foot differential in their height. But if we took 1,000 of the same men and said, well, how many, what is their economic worth? Well, some may actually be bankrupt, I have no money, and others may own a property in a city, and the flat could be worth several million rupees. So you have a much wider deviation in terms of the net worth. And the same is true in investing. Some investments have a very small standard deviation, don't move very much. Others have a very big deviation and are very volatile. And provided you're being rewarded and you get a good return, then you don't mind having a lot of volatility. So all you do is take your growth, how much is your money actually made, take away risk-free return, what would you get in the bank or what would you get on long-term government debt, and then divide it by the volatility, the standard deviation of the return. And this is a system that institutional managers use, and we would strongly recommend that private investors look at the Sharpe ratio of the investments that they're going in, because that can help point out, actually, was it worth holding Bitcoin? Were you rewarded for that extra volatility? And unfortunately, over certainly the last 10, 7, 5, 10, even 3 years, the Sharpe ratio on Bitcoin has actually been very impressive. Whether that'll be the case going forward or not, who knows? But again, it's just a different way of looking at investments, and one we would thoroughly recommend people look. So what we are going to see is, as we see more and more assets moving to a digitized format, markets themselves will actually trade on a global basis, and they'll trade 24 hours a day, 7 days a week. We are going to see more and more assets which are digital, and we are going to be using blockchain technology, lower the costs of investments and also lower the costs of doing business. So for example, importing goods from India into Europe, we're going to see much lower costs as we strip out a lot of the intermediaries and the paperwork, and potentially a lot of the corruption that goes on moving goods around the world, because the combination using blockchain, Internet of Things, artificial intelligence, you'll have much greater visibility of where these goods are in the supply chain and when they're due to be delivered and how they're actually processing, so people know what's actually going on. I also think we're going to see a lot more engagement. I think we'll see countries embracing blockchain technology in voting, so that there'll be faster results and obviously less opportunities for manipulation and corruption. We'll also see voting, whether it's for shares and companies, so that you'll see that in real time and they give you access to the managers of what they're actually doing. Going back to investments, we also have the ability to pay dividends instead of dividends and rental income being paid on a quarterly or even a 6-monthly basis. There's no reason why dividend income couldn't actually be paid on a weekly basis potentially. So that would make it a lot more smoother in terms of the income. And then also we have the ability within the financial services world for surveillance of your portfolio on an automatic basis and rebalancing your portfolio so you're not suddenly exposed to an asset class that you didn't realize. But overall, it's giving much greater transparency, whether that's in financial services we're talking about here, or whether it's in supply chains, or indeed whether it's actually in medical fields, whereby we're actually to see much greater knowledge of what's actually happening with the drugs and where they are at any one time. Now, in order to get more information, by all means, email me, johnny.fry@teamblockchain.net, and very happy to send you the weekly analysis digital bites, which will give you a summary of what's happening right across the world in different industries, whether it be agriculture, whether it be retail, whether it be pharmaceuticals, or indeed whether it be financial services. And what we're looking at is different examples and case studies, not just what's happening, what are the likely impacts of how it's going to impact our lives on an ongoing basis. Thank you very much.